We're going to look at exactly what shares are, where they come from, plus a basic introduction to how they are sold on the markets. If you're going to invest in the stock market, we had better start with what it is that you are actually buying. As an investor, you will be buying what are known as ordinary shares, which means that you, together with all of the other investors who have bought shares in a particular company, will become the joint owners of that company. Shares are created when a company is set up and the first investors put money in to get it going. Staff may need to be hired, materials sourced, and so on. All this before any money comes in from customers. In return for cash, investors are allocated a stake in the company. After that, the shares can be bought and sold any number of times. In these subsequent sales, the buyers buy the shares from the existing share owners, not from the company. The proceeds go to the existing share owners. This is just like buying your own home. If you buy a new build, you pay the builder. After that, the next buyer buys from you as the existing homeowner. The issuing of new shares by the company is known as the primary market, as it is the first time that the shares have been allocated to investors. When these shares are subsequently bought and sold on the stock market, this is known as the secondary market. Companies do not have to have their shares traded on the stock market. For example, shares in retailer John Lewis are held privately by the staff. However, for the moment, we'll only be looking at publicly listed and traded companies. That is, the ones whose shares are quoted on a stock exchange. These are the shares that the general public is able to buy. A key question to ask, of course, is why should you buy shares in a company? As a shareholder, you have a right to a say in the decision-making of the company and a share in any profits that are paid out in dividends. You can attend an annual meeting where you can ask questions, receive information on the company's accounts, and vote for directors and auditors. You will also be able to vote to approve or veto any proposed major acquisition of another company or the proposed sale of a part of the existing business. The number of votes you have and the size of your share of the profits will depend on how many shares you own. For example, if you have 1,000 shares in Marks & Spencer and someone else has 10,000 shares, they have 10 times as many votes as you and they will receive 10 times as much in dividends. Don't expect a conveniently round number of shares to be issued. For example, Twitter issued 544.7 million shares when it listed on the New York Stock Exchange in 2013, while Merlin Entertainments, owner of Madame Tussauds and the London Eye, issued 1.014 billion shares the same year.